Welcome to Breaking News to Trading Moves.
Glad to be here.
So we're looking squarely at the hardware sector today. There's a specific setup we really need to walk through.
We do. We've got a major update from AMD.
Right, regarding their financial outlook for Q1 2026. And this report, it's almost serving as a litmus test for the entire AI hardware landscape.
It's a really complex picture. I mean, you have some solid numbers, but then there are also some very clear warnings kind of embedded in the report itself.
Okay, so let's get right into the headline numbers then. AMD has issued guidance for Q1 2026 revenue. They're projecting approximately $9.8 billion.
And that's plus or minus $300 million.
Which on the surface, that's a strong number.
Oh, absolutely.
It actually beat the street estimates. But here is the catch, and this is what we need to talk about. Despite beating, this is a sequential dip compared to Q4.
And that's it. That sequential dip is exactly what caught the market's attention. When you're in a high-growth sector like AI hardware, any sign of a slowdown, even if it's just seasonal, it gets scrutinized so heavily.
The market reaction was immediate, wasn't it? We saw that negative price action after hours.
It was. It really seems like investors just looked at the guide and immediately started comparing AMD's margins and its, positioning against the current market leader.
That's the inevitable comparison.
It is. But we need to look at the specific headwinds that AMD actually cited because they tell us a lot about the broader constraints across the whole industry.
Okay. They listed a few specific challenges. The first one was just the demand for AI accelerators.
Right.
Then they got very specific about limits regarding MI308 shipments to China.
That China restriction is a critical detail. It puts a hard ceiling on a specific part of their potential revenue,
So if you can't ship your best product to one of the largest markets because of export controls?
Exactly. That volume has to be made up somewhere else or just poof, disappears from the model.
And then there's the third headwind, which I think might be the most critical one for the broader market. The tight supply of high bandwidth memory.
HBM.
HBM.
Yeah, HBM is the bottleneck. We've seen this theme pop up again and again. You can have the most powerful GPU or accelerator in the world, but if you don't have the high bandwidth memory to go with it, you can't ship the unit.
And AMD is saying that directly.
They are explicitly saying this tightness is impacting their ability to meet all the potential demand out there.
So let's try to make sense of this for the traders listening. We have a beat on revenue, but a dip in momentum and some really clear supply chain headaches.
We have to look at the market context here. There are, I think, three main themes that emerge from this that really matter for how you trade this environment.
Okay.
The first theme is what I call the bar is rising.
We see this all the time during earnings season, don't we? It feels like just beating the estimates isn't good enough anymore.
Precisely. We're in a phase of the market where investors are demanding perfection. It's not enough to just clear the hurdle.
They want more.
The market wants to see accelerating growth combined with strong margins. So when a company like AMD comes out and says, hey, we beat the number, but we're dipping sequentially, well, that violates the accelerating growth rule.
It's such a tough standard. You could be doing well, but if you aren't doing perfectly, the stock gets punished for it.
That's just the reality of these high expectation trades. But this leads us to the second theme, which is actually a positive signal. We need to talk about infrastructure spending.
Right. So just because AMD has a specific dip, that doesn't mean the whole AI spending trend is over, does it?
Not at all. The broader trend of AI infrastructure spending is fully intact. The demand for compute for data centers, for training models, that's not going away.
So this AMD report actually confirms the demand is still there.
Yes. The issue is on the supply side and with specific product execution. This is a positive signal for the broader hardware stack, despite AMD's particular challenges.
So the appetite for hardware is still massive.
Massive. Which brings us to our third theme, the supply bottleneck. We mentioned that HBM tightness earlier.
The memory issue.
Yeah. The mechanism here is simple, but pretty brutal. If memory stays tight, it bottlenecks the shipment of GPUs and accelerators across the whole industry, not just for AMD.
And that has a consequence for who actually makes money right now.
It does. It creates a specific environment that favors what we call the picks and shovels suppliers over the chip makers themselves, at least in the near term.
How so?
Well, if the chip makers are all fighting over a limited supply of memory, the companies that make the memory, or the companies that build the servers once the chips finally arrive, they find themselves in a much stronger position.
That is a perfect transition. Let's talk about the winners. Based on this news and the logic you just laid out, who benefits? We have three categories here.
Okay, the first category is AI server and rack integrators.
So these are the companies that are actually putting the physical machines together.
Correct. The logic here is pull-through. When you have higher shipments of accelerators, and even if supply is tight, volumes are still historically high. It just pulls through demand for the complete systems.
You don't just buy a chip and set it on a desk.
No, you need the server chassis, the racks, the power units, the cooling integration, all of it.
And I assume that integration is getting more complex, which probably helps margins.
It lifts the overall volume, but it also increases what we call the services attach rate. These integrators aren't just shipping boxes, they are helping set up complex liquid-cooled environments.
Okay, let's get to the tickers. Who are the names to watch in this integrator space?
We're looking at the major players in enterprise hardware.
First up is Supermicro Computer. That is ticker SMCI.
Right, they've been very aggressive in these rack-scale solutions.
Then we have Hewlett-Packard Enterprise, ticker HPE.
A legacy player that has pivoted really hard into these AI server offerings.
And of course, Dell Technologies.
Ticker DELL. Dell has a massive enterprise footprint, which helps them capture this infrastructure spend.
So that's category one, the folks building the boxes. Let's move to category two, memory, HBM, and storage suppliers.
This goes right back to that bottleneck we were just discussing. AI accelerators require expensive, high-performance memory. And right now, capacity is really constrained.
And in economics, constrained supply usually means
Pricing power. When buyers are desperate for HBM to finish their expensive GPUs, the memory suppliers can hold the line on price.
it gives them a lot of leverage.
It also gives them much better visibility into their backlog. They know exactly what they're going to sell for the next few quarters because everyone is lining up for it.
Puts them in the driver's seat. So who are the tickers here?
You want to look at the primary manufacturers of memory and storage.
First is Micron Technology, ticker MU.
A key player in the HBM space.
And Western Digital, ticker WDC.
Right. Storage is the other side of the coin. All that data being processed needs to sit somewhere fast.
Okay, category three for the winners, AI data center networking.
This one is often overlooked, but it's absolutely critical. As these AI clusters scale up, we are talking about connecting tens of thousands of GPUs. You need incredibly high-speed switching and interconnects.
It's basically the plumbing of the data center.
Exactly. Rising GPU density leads directly to increased demand for high-throughput networking gear. You can't have a fast brain with a slow nervous system. The data has to move between the chips instantly.
So who provides that speed?
We're looking at the leaders in high-speed Ethernet and custom switching.
Arista Networks is a big one here, ticker ANET.
They are very, very strong in the hyperscale data center market.
Broadcom, ticker AVGO.
Broadcom provides a lot of the custom silicon that makes these switches go so fast.
And Cisco Systems?
CSCO, even the giants are retooling for this high-speed AI traffic.
So those are the winners, integrators, memory, and networking. But for every trade, there's a counter trade. Let's talk about the losers. Who gets hurt by this kind of setup?
Okay, the first category of losers is what we call legacy by 86 share pressure. Or you could call it catch-up compute.
Catch-up implies they are behind.
They are. We talked about how AMD is facing some headwinds, but we have to remember AMD's server CPU platform is still gaining mindshare. They are very competitive. And as they advance their AI roadmap, the lagging incumbents, they just face pricing pressure.
They have to drop prices to stay in the game.
Exactly. They face a weaker mix of sales. They might still sell chips, but not the high-margin premium chips that investors want to see.
So who is in the crosshairs here?
The traditional giants of the processor world.
Intel is the obvious one, ticker INTC.
Yeah, they're fighting a multi-front war right now.
And International Business Machines, ticker IBM.
They have their niche, but that broader by 86 pressure, it impacts the sector dynamics.
Okay, category two for the losers.
Yeah.
PC-exposed hardware. Now, this one seems a bit separate from the data center talk.
It is, but it's connected through the memory market. We talked about the trickle-down cost effect.
How does that work?
Well, if memory pricing is tight because all the capacity is going to AI, the price of memory for everyone else goes up. And that pushes the price of end devices like laptops and desktops higher.
And if laptops get more expensive?
Consumer demand softens. It weighs on the broader hardware cycle that's adjacent to PCs.
So who gets hit there?
The companies that really rely on selling those physical boxes to consumers and offices.
HP, ticker HTQ.
Highly exposed to the PC cycle.
And Logitech, ticker LOGI.
Yep. If people aren't buying new PCs, they often delay buying new mice, keyboards, and webcams.
That makes perfect sense.
Yeah.
Now, this third category of losers is a bit nuanced. You call this high expectation AI trades.
Right. This goes right back to our opening theme about the bar rising. The market right now is rewarding clear dominance. So anything that appears good but not great risks a sell-off.
We call that multiple compression.
That's it. The stock price goes down not because the company is failing, but because the valuation multiple, the price investors are willing to pay for $1 of earnings, it just shrinks. The expectations were set for perfection, and they didn't meet it.
And ironically, the subject of our entire discussion today falls right in here.
Yes, advanced micro devices, ticker AMD. Despite the news, despite beating revenue estimates, they fall into the loser category here, specifically because of that market reaction to the guidance.
And you also have Supermicrocomputer in this list.
I do.
Wait, hold on. We just listed them as a winner under Integrators.
And that is the nuance. They are a winner on volume and integration. Their business is growing, no question. But they are a potential loser if you view them purely as a high expectation trade that's facing compression.
So it's about the expectation.
It's all about the expectation. If they miss a beat, or if the market decides their margins aren't expanding fast enough, the stock can get hit hard even if the business is growing. It's about that gap between expectation and reality.
That's a crucial distinction. You can be a great company but a risky trade if the expectations get too high.
Exactly. Ticker SMCI sits right on that razor's edge.
So we've covered a lot of ground here. We started with AMD's Q1 2026 guidance, $9.8 billion. Beat estimates but showed a sequential dip. We talked about the headwinds from China restrictions and HBM tightness.
And we connected that to the broader market. I think the key takeaway is that the AI trade is very much alive. The infrastructure spend is real. However, the criteria for success have narrowed.
It's not a rising tide that lifts all boats anymore, is it?
No, it's about supply chain dominance and margin perfection. You need to either control the bottleneck, like the memory suppliers, or you need to be the one integrating the final product. Being in the middle with just good results isn't enough to satisfy this market.
Which brings us to the end of our discussion. I want to leave you with a thought based on that bar is rising concept you talked about. If beating estimates is no longer enough, if good is now treated like bad, what does that mean for the volatility of the entire sector moving forward? If perfection is the baseline, any small slip could lead to some really outsized moves. It's something to keep in mind as you look at your portfolio.
It certainly suggests a bumpy ride ahead.
Absolutely. Before we sign off, I do need to remind you, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for listening to Breaking News to Trading Moves. We will catch you next time.